Hello and welcome to Damien's Market Update. Now, Midweek Markets was a show that you all loved, and in fact we put it on holiday for a short period of time while we decided what we're going to do with the show and how it might change. And we were flooded with messages from you guys asking that we bring it back and how much you relied upon it and loved the show. So what I'm going to do going forward, we're going to do these updates at least once a month. So it's going to be a monthly update on markets. And if you want a more frequent update, say something happens in the bond or equity markets and you want to have some insight, then make sure you leave a comment below the video, because we'll be checking all the comments on the videos on YouTube. And if there is a desire for a sooner update than the usual interim period of say 4 weeks, then we will listen, take note, and we will likely pop in a new show. And of course, if you listen to this on our podcast feed, then you can leave comments on the YouTube, or you can message me via Twitter or Facebook or Instagram. Of course, you can email me via Damien@moneytothemasses.com. So what has been happening since the last show that I made? And that was about 3 to 4 weeks ago, and that title of that show was Markets Looking for Direction. And they were. The S&P 500, for example, in America was stuck at that key 4,500 level, sitting just above its 200-day moving average, which, if you remember, sitting around that moving average is a key point, because if you break below it, that is usually negative for the index. If you break above it, that's usually quite bullish. Now, in Europe, the German DAX was sitting around 14,160, well below that important 14,500 level, while in the UK, the Ftse 100 was still proving very resilient and was just below the 7,600 level, which is a level it really wanted to break above if it was going to revisit that all-time high that was set back in 2018, and that was of 7,877. Well, a lot has happened since the last show. Most of it has been negative for the typical bond and equity portfolio, meaning that bond and equity markets have taken a bit of a hit. Looking back, April was mostly dominated by speculation on the likely change to monetary policy from the main central banks, with inflation and, well, specifically energy price inflation grabbing the headlines. With inflation rates hitting new highs in the US, UK and the Eurozone, opinion oscillated between fear that central banks would be too heavy-handed in their approach and stunt economic growth, or conversely, that they would not do enough and actually inflation would get out of control and pressures would intensify. Now, initially, bond markets seemed to be paying attention to what central banks were telling us about the future direction of monetary policy. Well, if you looked at the 10-year US Treasury yield, for example, it exploded high and eventually hit 3.2% in early May. But after my last show, equity investors seemed to take a bit of an overdue reality check. And once again, we began to see equity and bond markets falling into step and moving in line with each other. So that positive correlation. It means that the year-to-date typical 60-40 bond equity portfolio, that means a 60% equity, 40% bond, is down about 8.8%. Now, the good news is my own 50k portfolio, which I actually run on 80/20 Investor, is down just 3.8% year to date. Now, that's largely because I've diversified beyond just those two assets, i.e. bonds and equities. Now, shrewd investors sought diversification elsewhere, with commodities one possible choice, although still subject to quite a bit of volatility. Now, if you look at the S&P GSCI, which is a composite index of commodities, it's up over 26% year to date. That's far outstripping the almost wall-to-wall losses you've seen across equity markets. And that is despite a 6% pullback this week in commodities. And that pullback was because of concerns around China's zero COVID policy, with its lockdowns, which threaten to hit global growth. Now, if large-scale lockdowns, which we've seen, if they continue in China, then it's unlikely to meet its 5.5% growth target this year. And unsurprisingly, Chinese equities have been battered this year, with the CSI 300 index now down 20% year to date. Now, just a few days into the month of May, and we saw intense reactions to monetary policy decisions from both the US Federal Reserve and the Bank of England. Now, the Fed increased interest rates by 0.5% and indicated that it would soon reduce its balance sheet by reducing its bond holdings. So effectively, think of unwinding QE. Now, the S&P 500 leapt 3% on the back of the announcement, seemingly relieved that the Fed hadn't actually hiked rates by 0.75%, which there had been threats that would happen. Now, the market was obviously relieved. It bounced, but equity market, that bounce, that was relatively short-lived, and it eventually crashed soon after. And the tech-heavy NASDAQ 100 bared the brunt of that selling once again. And Bitcoin followed suit. And the latter is quite interesting because Bitcoin has fallen 30% in the last month alone, and it's broken back below that key $30,000 level. And Bitcoin, if nothing else, is a good indicator on the lack of investor risk appetite out there generally. Now, the Bank of England raised its interest rate from 0.75% to 1% as widely predicted, but it also said that inflation would rise above 10% by the autumn and the UK economy would likely contract in 2023, and that took people by surprise. And it's probably no wonder that there's been volatility in equity markets globally, and there has been a pullback in risk appetite. And the VIX index, so the VIX, that's a volatility index that's over in America, and it's typically called the market fear gauge. That breached 30, which is well above its long-term average of 20. And to be honest, 30 is really the danger zone. And when you get that, you tend to see a pickup in volatility in equity markets, and it's often to the downside. Now, with explicit warnings from governments and central banks that economic conditions are going to worsen, it would perhaps be premature to assume we are over the worst of the equity market volatility. Stagflation is the buzzword in markets, which is something I've been talking about on these shows for some time, and that is slowing growth alongside inflation. And it's the interaction between market fear of inflation versus the fear over a lack of economic growth that will likely change the current trends we are seeing in markets. That's both bond and equity markets. Right now, the fear of inflation is hurting bonds more than the fear of slowing growth can support bonds. And as soon as investors think that inflation has peaked, then don't be surprised if we see a rally in bonds as economic growth fears take center stage. And if economic growth fears emerge, then don't be surprised if we see tech stocks outperform cyclicals once again. Yet with so many narratives and headlines that are competing, it pays to focus on objective facts such as index price moves during the current sell-off. So let me sort of round up and finish this episode by doing just that and giving you a few markers to look out for, which I've taken from a technical analysis piece that I produced last week for 80/20 investor members, which got obviously a lot of positive feedback. Now, as I make this show, the S&P 500 is at 4021, having had a torrid time of late. Now, if we break below 4,000, then numerous support levels exist below there, pretty much every 100 points below, so 3,900, 3,800, and we got quite a strong one at 3,750. Now, many people called the bottom of the current sell-off back in March, which was clearly premature, and I wouldn't be surprised by anything right now, whether that's to break higher or lower. One thing to note is that the recent rallies we've seen in the S&P 500 have been sold and faded by investors more quickly each time, which suggests that the enthusiasm on the rebounds is starting to wane. That is something that could be quite negative if we don't see a change. On the upside, 4,300 is important. We need to break above that if we're going to get any sort of excitement about this market coming back. And once we get above there, then we can talk about the 200-day moving average once again and that key 4,500 level, which is now a pretty significant barrier of resistance. If we look at the UK, the Ftse 100 sits at 7345 as I make this show, and it remains in an uptrend that goes back to January 2021, and it's above its 200-day moving average. That shows you how positive UK equities have been, and it's the one market you really wanted to be long of if you wanted to avoid most of the carnage that we've seen in global equity markets so far in 2022. And that's because of the exposure the FTSE 100 has to energy stocks and oil stocks. To the upside, we need to break above the recent high of 7672 to avoid a double top forming, which is a bearish sign from a technical analysis point of view. And that means that when you see that almost upside down W, when you look at the chart on your app on your phone, if you get that double top and it starts to break down, then it can be bearish and mean that you're going to get to a new low. But what you want to see is that breaks. We go above that, it negates that double top, and we could therefore push back to those all-time highs that I mentioned back in 2018. But we've got a long way to go. To the downside, of course, we'll feel always happier if the FTSE 100 keeps above 7,150. But finally, I need to mention the pound. Now, the strength of the pound has collapsed over the last month. And once again, we broke down below that $1.30 level. And then the bottom completely fell out that market. And we then went down to $1.23. Now, on the one hand, obviously, if you're going to America, that makes your holiday more expensive. But it was also helped buoy the FTSE 100. Now, don't forget that a lot of the company earnings in the FTSE 100 are actually overseas, and a lot of them in dollars. So it means that if the pound weakens against the dollar, then those dollar earnings, when you convert them back into pounds, are even more impressive. So therefore, that is bullish for the FTSE 100. But it's also meant that weakness in the pound has meant that the US portion of your portfolio has actually been buoyed as well. So that's whether it's equities or bonds. So it means that the global part of your portfolio, because any global equity funds or global bond funds that you have mostly are exposed to US equities and US bonds, they've been insulated from the worst of the recent sell-off you've seen in both bond and equity markets because of that currency kicker. And then also you see that divergence starting to occur between the European assets, so European equity markets and US equity markets, which is partly, I think, because of the divergence we're seeing in the monetary policy outlook for both of the from either side of the pond. So if you look at the US, the Fed is tightening monetary policy quite aggressively, and people are thinking it could even go further. Whereas in the Eurozone, for example, the pace of monetary policy tightening is actually being priced to be far slower. So that's been actually very negative in a way for the euro versus the dollar. So that is something to keep an eye on in the coming months. Are we going to see a divergence in the fortunes of, in particular, European equities versus US equities? Because we've seen it of late, because we haven't seen European equities. Look at the DAX on your phone. You haven't seen the German DAX hit its recent lows, the lows of March again. Whereas in US equities, not only did we reach those lows that were seen in March, we broke even below those as well. So that divergence will be something to keep an eye on in the coming weeks and months. So that is it for this week on Damien's market update. As ever, you can contact me via email, damien@moneytothemasses.com. You can contact me via Twitter, money to the masses with the number 2. And of course, you can find me on Instagram, TikTok, and Facebook. And most importantly of all, please subscribe to our YouTube channel.